Welcome, everyone, to the Capital Markets Update from Principal Wealth Partners. I'm Jelena Ogilvie, Partner and Director of Business Development. As we enter 2022 with volatility in the markets, we wanted to put some perspective around this. Why and how are we seeing this? The impact of the Federal Reserve, not just on bonds, but stocks. Thoughts on this year with the economy and an upcoming midterm election. And finally, comments around market resiliency. After a strong 2021 return, 2022 is already shaping out to be very different. The S&P is shown here in the upper left is down this year about 4%. In fact, closer to 5% as of the 19th of January. The NASDAQ and Russell 2000, shown right below, are down further at 7% during this time. It's important to note that these are market cap weighted indices. The S&P, as an example, has about 10 companies that make up almost 1/3 of their return. If you look further under the hood at these three indices over on the far right, you will see that 26% of the 500 companies in the S&P so far this year are off at least 10%, and over 50% of the broader indices below them, meaning there is more volatility amongst these companies, in particular, the more growth-oriented names. Despite media hysteria that can occur during market declines such as this, it's important to know that they're common. In fact, as shown here on the upper left, 5% drawdowns happen all the time. On average, about 3 times a year. We just haven't seen this as much because of the pandemic, given all the stimulus that was thrown at us. What we see occurring isn't necessarily uncommon as the media may portray it to be, but rather this is a return to normalcy. Before we talk about where this volatility is coming from, I want to draw some attention to last year, and we would argue that the volatility began in 2021, but was missed by a lot of the media because they tend to focus only on the broad return, such as the S&P and the Dow. Despite impressive returns in the market last year, with the S&P as an example up 27%, all three indices by the end of 2021 had roughly 90% of their companies down at least 10% some point during the calendar year. In fact, we had a decline on the S&P last October of 5%, as shown here on the upper right. With most other indices below the S&P last year and the traditional bond market down, depending on your diversified allocation, most portfolios for 2021 are more in line with a high single-digit return. So let's talk about where this volatility is coming from. Despite a continued wall of worry that investors can build, when the markets get emotional as they are now, they tend to be laser focused on one issue. That right now is the Federal Reserve. The strength of the Fed through the pandemic was massive and twofold. One was lowering federal funds rates essentially to zero, as they did after the financial crisis, which you can see here from the solid blue line at the bottom of the page. This rate is essential in that it alters the cost of borrowing in the overall economy. The second was the $120 billion a month in bond purchases to provide additional liquidity to the markets. The consensus is that they will start a path towards normalization as they have a dual mandated role of first, full employment, and second, an inflation target of 2%. The Fed has admitted that we are at or near full employment. In fact, unemployment is now back to pre-pandemic levels. Inflation, well, that's well over 2% right now. In fact, the highest in 40 years and causing some concern. And the Fed recently removed quote unquote transitory from their language, meaning inflation won't go away as soon as they had hoped. At this point, they can no longer justify buying $120 billion a month in bonds and keeping interest rates essentially at zero. The Fed today is pivoting, and they're doing so quickly. The question that arises is how aggressive should they get? This came up late last year when they announced a sooner and faster tapering of the bond purchase program and the possibility of 3 rate hikes, as shown here with the blue line. The continued volatility this year was an amendment to 4 possible rate hikes this year. This volatility has been felt in both stocks and bonds. The Fed has a critical role of finding the right balance in how they implement their path to normalization. This is key as we look longer term to future economic slowdowns. They need to retool to ensure that they have the ammunition to be accommodative when the need arises in the future. With the volatility in the markets, it's important to have perspective on the overall economy. The US economy, as shown here in green, continues to lead the global recovery, with the exception of China on the far right. We are in what's known as a mid-cycle, where after massive fiscal and monetary stimulus, record earnings, record growth, we start to see a slowdown. The economy is still growing, but we start to see peaks in economic growth, corporate earnings, and a policy shift from accommodative to tightening. 2 points to note. First, an economy overall, which is shown here on this page from early cycle on the far left to mid where we are today, to late and then into a recession on the right, can last over a 10 to 12 year period. And second, that the mid cycle tends to be the longest phase of an economic cycle overall. In other words, these cycles don't shift overnight. We wouldn't be surprised if we were in this mid cycle for some time. The beginning of a new year always brings fresh new outlook from economists as to what might transpire. 2022 has been no different. Themes like winds of change, the wake-up call, back to the future are examples of some of the 2022 outlook summaries from some key economists in the industry, indicating many of them seem to agree with this shift that's expected in this year. Yes, we remain optimistic equities. We see strong corporate earnings, a continuance of share buybacks, which are supportive to the market, and ridiculous amounts of cash sitting on the sidelines. However, we also want to be cognizant of the future expectations of the economy. Strong corporate earnings for 2022 may be the market consensus of 8%, which is great. It's just not the 45% earnings growth from last year. And finally, an important topic this year will be the midterm elections. With data going back to 1930, there are some interesting observations. The first 10 months from January to October of a midterm election year tends to underperform. In this study of the Dow, it's 1% versus 5.6% in non-midterm election years, as shown on the left. October then tends to outperform, as highlighted on the right, at 14.3% versus 8.3% all other years. An interesting note, regardless of the party in office, that current party tends to suffer in a midterm election year. Only twice has that party gained seats in both Senate and House, and that was FDR and George W. Bush. The volatility also increases during this time with another layer of political uncertainty. A final observation that I'd like to make on the markets, it's easy and emotional to focus on the current wall of worry. It's constantly around us, and it's important to be aware of these concerns. One of the hardest decisions as investors is to cut out the noise as you make your investment decisions. Here is your wall of worry dating back to the financial crisis of 2008. There's so much on here, it's hard to read. So let me just highlight a few. It includes not one pandemic, but two with the H1N1. It has terrorist attacks, hurricanes and earthquakes, government and corporate bailouts, multiple Fed fund rate hikes, and even the downgrade of US debt. It goes on, and yet despite all this, the S&P continues to grind higher. In times like these, it may not feel like it in the short term, but make no mistake, our markets are incredibly resilient in the longer term to this wall of worry. In conclusion, the conditions of the overall market still look good, but gone are the days of a roaring recovery fueled by reopening and unprecedented monetary and fiscal stimulus. The return going forward should be more moderate, risk should become more apparent, but with that comes opportunity. We remain committed to finding these opportunities in the markets when they are presented to us. Thank you for your time, and we're here for you, so please reach out to us if you have any questions.